The underwriter is now tasked with determining whether or not the business has the stability to continue to stay in business through COVID-19 and beyond. Hey everyone, Travis Spear from Pine Financial Group, where we work together so you succeed. Thanks for joining me today here on YouTube or Facebook and checking out our video. Please be sure to subscribe, like, share, comment, and leave some messages below. We'd love to interact with you. You can check out our videos every Friday as we put out fresh new content, and I often wear the same shirt. Today, we're going to talk a little bit about lending changes as a part of COVID-19. I have to tell you that I was surprised in having a conversation recently with one of our borrowers who was working on a fix and flip deal, and he was looking at taking an FHA contract and was actually unsure of some of the changes that came into play that could have affected his ability to close. So I want to share a couple of those changes with you. As sellers, we need to be sure that we're looking at the changes and making sure that we are speaking with the buyer's lender to make sure that none of these issues are going to affect the buyer and make sure they have the ability to close on your property in time. So one of the big ones for FHA was credit score change. Traditionally, credit score would allow you to go down to 580 on FHA. And now we're seeing some banks have overlays as high as 620 or 640, which is a significant change in credit score requirement for an FHA loan. So it's really important to understand that. And if you're taking an offer from an FHA borrower, you might want to have that conversation with their lender. These rules went into play about 3 weeks ago. So if somebody filled out an application in the last 3 weeks, they're going to be affected by this. So that's likely going to affect you. So make sure you're working through that. The other thing is some banks are going to require a 6-month reserve overlay. Now, this is important because if you're working with an FHA borrower who's typically putting 3.5% down, and now they're going to have their money down plus the traditional requirement, which I believe was 2 months, but now they're going to have 6 months in the bank, that would likely change their ability to qualify for the loan. So how is this important to you? As a fix and flipper or as a seller, you're going to need to know if your borrower can hit that reserve requirement. If they have been shopping for a house for a few months and continuing to get beat out and their lender wasn't proactive enough to reach out to them and let them know of the changes that are going on and you go under contract, you're going to need to know pretty quickly whether or not they can meet that requirement or if the lender has those overlays. Another one that FHA came out with, and most people maybe aren't always hip to the terms, but FHA is actually the Federal Housing Association. They actually insure the loans. They don't actually make the loans. And with a recent change with all the forbearances happening is that insurance policy, who protects the lender or the bank who ultimately finances the deal, if it goes into default, then they're protected from that. Something FHA came out with recently is that if a borrower takes an FHA loan and goes into forbearance before the loan is actually insured by FHA, which typically takes between 30 to 90 days, then the lender who originated the loan would actually be on the hook for up to 20% of the original principal balance. So let's say you had a buyer bought a house for rough numbers, 210, their loan was $200,000. They close on the loan, everything's good. 45 days later, someone loses their job and they need to enter into forbearance. FHA could require the lender who originated that loan to cover up to 20% of the loan balance if it goes into forbearance and ultimately into default. So 20% on 200 is $40,000. So how are lenders going to protect themselves in this case? You're going to see some overlays from lenders requiring, I mentioned that 6-month reserve, but maybe 6 months or maybe more or less to guarantee that payment can be made. I also read an article where some may actually require prepayment of 2 to 3 payments to make sure they could get past that between 30 and 90-day period so that loan would be insured and ultimately protect the lender. So what does all this tell you? It's important to know what's going on in the lending community. One other thing about FHA, and this isn't new, but this is one that I just had a conversation with somebody the other day on, the anti-flipping moratorium. So years ago, probably pre-2010, the FHA had a flipping moratorium, which meant that you couldn't resell a house for more than X percentage within 90 days. For a lot of years, 6 or 7 years, they put a moratorium on that so that FHA buyers could be a little bit more competitive in the marketplace. About a year and a half ago, that actually the moratorium expired and FHA is now enforcing that 90-day flip rule. This means that if you buy a property, fix it up, and go back on the market, let's say it's a quick fix up, you're back on the market in 30 or 45 days, you can't accept FHA offers until you hit day 91, and that's from when you closed on the property. So what I actually just saw recently was somebody bought a property, did a quick rehab on it, was going back on the market. They bought it off market, so they had a big spread in it, and the buyer came with an FHA contract. You can't even order the appraisal until day 91. And so that would have left him basically sitting there for about 45 or 60 days before they could even start to underwrite the loan. So probably another 15 to 30 days after the 90 to get the deal closed. It's important to understand this. So if you're within that 90 days, be sure that you're looking at other offers, including conventional loans, to make sure you can get that closed quickly. Some other changes that are taking place in conventional is for Fannie and Freddie. This is also going to be important for you to know whether you're a home buyer, seller, or even a real estate agent. Self-employed borrowers are going to take a little bit of a hit here to get loans from Fannie and Freddie in the near future. So here was a recent change. They're requiring year-to-date audited P&L for self-employed borrowers or a year-to-date non-audited P&L with two of the most recent bank statements. But if you're running a business and you've got a lot of deposits into your account, what do you think they're going to want next? For you to explain every one of those deposits, back it up with an invoice and a check and that type of thing. So this is important for you to know if you're selling a property and the buyers are self-employed. Have they submitted this P&L to make sure that they're going to be okay to get the loan done? This goes even a little further and becomes really subjective. The underwriter is now tasked with determining whether or not the business has the stability to continue to stay in business through COVID-19 and beyond. So you've got somebody who's looking at records who isn't necessarily trained in this specific space to decide whether or not this borrower is worthy enough, even if they hit the credit score minimums, down payment, income, and all of that. Now they're going to dig into where that income came from and whether or not the income is going to be stable going forward. This is important to understand if you're out there buying and selling properties and you're working with self-employed borrowers. The onus is going to be on the borrower to show that their business was not affected by the coronavirus and that they're going to be okay going forward. Now, I got to tell you, there's not too many businesses, self-employed or not, that were not affected in some way by COVID-19, I guess with the exception of Amazon and the grocery store. So if the borrower was, let's say, as an example, a hairstylist, in our market in Denver or in Colorado, hairstylists were closed down for almost 6 weeks. So you were out shopping for a house and now you're going to show that you can still afford it, even though you didn't have the ability to work for the last 6 weeks, even though, say, the last 2 or 3 weeks have been the busiest you've ever been in your life. This is going to be important to understand and be able to navigate as we're working with self-employed borrowers. Really what it comes down to is, one, understanding all of the effects that COVID-19 is having on borrowers' ability to buy and support debt service, but really to have really good relationships with your lenders. You're going to want to work with direct Fannie or Freddie lenders that are going to make it less difficult for your buyers to have the ability to buy your property. Now, when things were a little slower, we used to see things like concession if you work with my preferred lender. Maybe it's a time to consider doing something like that if it's going to cost a couple $1,000s in concession to make sure your buyers are going to be able to get across the finish line. The other thing is focusing on local banks and portfolio lenders. I've continued to see local banks still have an appetite for good loans. And although Fannie and Freddie is typically going to be the lowest cost and kind of best option for a borrower, it may not be the best option to get the deal closed. So you want to consider some of your local banks and focus on those relationships to make sure you can get deals done. As always, thank you for joining the video today. If there's anything we can help you with at Pine Financial Group, we're hard money lenders. We raise private money from people just like you and lend it to people just like you. We're staying busy. We're closing a lot of loans. We'd love the opportunity at your business. We're financing experts. So even if we're not the best fit for you, we'd love to point you in the right direction. Thanks.